Good morning, everyone. Allow me to share with you the topic for our group discussion. So, our topic for today is all about the last step of accounting cycle, and we have three subtopic here, which are preparing the closing entries, post-closing trial balance, and reversing entries.
What are closing entries? Closing journal entries are made at the end of an accounting period to prepare the accounting records for the next period. They zero out the balances of temporary accounts during the current period to come up with a fresh slates for the transactions in the next period. Example for closing entries. A closing entry is to transfer all revenue and expense account totals at the end of an accounting period to an income summary account, which effectively results in the next income or loss for the period being the account balance in the income summary account. Then you shift the balance in the next income. What are temporary accounts? Temporary accounts include all revenue and expense accounts, and also withdrawal accounts of owners in the case of sole proprietorships and partnerships. So, example of temporary accounts are revenue accounts, expense accounts such as the cost of goods sold, compensation expense, and supplies expense accounts, and loss accounts such as the loss on assets sold account, and the income summary account.
4 steps in preparing closing entries. Number 1, close all income accounts to income summary. Number 2, close all expense accounts to income summary. Number 3, close income summary to the appropriate capital account. Owner's capital account for sole proprietorship. Partner's capital accounts for partnerships based on the ratio agreed. Retained earnings for corporation. Number 4, close withdrawals distribution to the appropriate capital account. So we have here closing entries example, and this example is from Gray Electronics Repair Services, adjusted trial balance on December 31, 2021. So as you can see, account title, we have cash, accounts receivable, service supplies, furniture and fixtures, service equipment, accumulated depreciation, accounts payable, utilities payable, loans payable, Mr. Gray capital, Mr. Gray drawing, service revenue, rent expense, salaries expense, taxes and licenses, utilities expense, service supplies expense, depreciation expense. So, accounts that has been debited are the cash, accounts receivable, service supplies, furniture and fixture, service equipment, Mr. Gray drawing, rent expense, salaries expense, taxes and licenses, utilities expense, service supplies expense, and depreciation expense. So the accounts that has been credited are accumulated depreciation, accounts payable, utilities payable, loans payable, Mr. Gray capital, and service revenue. Step 1. Close all income accounts to income summary. So as you can see here, we have table and we have here the date, particulars, debit and credit. So the date is December 31. Particulars, we have here service revenue and income summary. So service revenue is debited and we have here 9,850 pesos, and the income summary is credited and we have here also 9,850 pesos.
Step 2. Close all expense accounts to income summary. December 31. Income summary 8,790. Rent expense 1,500. Salaries expense 3,500. Taxes and licenses 370. Utilities expense 1,800. Service and supplies expense 900. Depreciation expense 720. To close expenses, we simply credit the expense accounts and debit income summary. Step 3. Close income summary to the appropriate capital account. Now for the step, we need to get the balance of the income summary account. And step 1, we credited it for $9,850 and debited it in step 2 for $8,790. It would be then have a credit balance for $1,060. Notice that the balance of the income summary account is actually the next income for the period. Remember that the next income is equal to all income minus all expenses. The income summary balance is ultimately close to the capital account. December 31 income summary is 1,060 and Mr. Gray capital is 1,060. For partnership, Each partner capital account will be credited based on the agreement of the partnership. For example, 50% to the partner A, 30% to B, and 20% to C. For corporations, income summary is closed entirely to the retained earnings. What if income summary had a debit balance? It means that the company had a net loss. This is the close by doing the opposite, debit the capital account, or decreasing the capital balance, and credit income summary.
Step 4. Close withdrawals to the capital account. So Mr. Gree capital as 7,000 and Mr. Gree drawing as 7,000. For sole proprietorships and partnerships, in a sole proprietorship, a drawing account is maintained to record all withdrawals made by the owner. In the partnership, a drawing account is maintained for each partner. All drawing accounts are closed to the respective capital accounts at the end of the accounting period. Our example is a sole proprietorship business. Mr. Gree withdrawals are recorded in Mr. Gree drawing. To close the drawing account to the capital account, we credit the drawing account and debit the capital account. Notice that the drawing decreased capital. So, for corporation, when dividends are declared by corporations, they are usually recorded by the debiting dividends, payable and crediting retained earnings. Note that by doing this, it is already deducted from retained earnings. A capital account hence not required a closing entry. However, some corporations use temporary clearing account for dividends declared. Let's use dividends. They recorded declarations by debiting dividends, payable and crediting dividends. If this is the case, then this temporary dividends account needs to be closed at the end of the period to the capital account retained earnings. Conclusion. The purpose of the closing entries is to prepare the temporary account for the next accounting period. In other words, the income and expenses accounts are restarted. After preparing the closing entries above, service revenue will now be zero. The expense account and withdrawal account will be now also be zero. Effectively, the balance of these accounts have been absorbed by the capital account. Mr. Gree capital, which now has a balance of 7,260 and 13,200, beginning balance plus 1,060 in step 3 for the net income, 7,000 in step 4 for the withdrawal.